very well. So I'm very excited to just break down, these concepts for you guys, make these things as simple as possible to understand. So let's dive right into it, right? I want to show you guys a strategy that I like to use on indices specifically, right? These concepts work on anything, whether it's Forex, stocks, indices, commodities, crypto. But I like to focus on indices specifically just because of the amount of points and pips that they move every day. You can catch some really good RR trades basically on the daily. So I'm gonna go ahead and break this down, right? So starting with S&P 500, I want to explain to you guys, my thought process on these trades today, and basically with this pair, right? Indices and S&P have been selling off pretty hard for the last couple of weeks, and after this massive sell-off that we had, I've noticed that we started to round off, right? Because market can't just sell and just go one direction forever, right? So once a market has taken out significant lows or liquidity, you can start to see something called accumulation start to build up. So you can start seeing the schematics, and I have an accumulation schematic right here just to reference, so it's easier for you guys to see this. So once we came out from this massive sell-off, I had noticed that we were rounding off and the schematic started to print, and I'll even label it for you guys so you can see it clearly. But you can notice that we had the preliminary supply right here. We had our seller's climax right here. We had our automatic rally, secondary test, and we had our secondary test in phase B. And then now we are putting in that spring right here. So the next thing that we want to do is basically anticipate test. So now that we put in the spring, all we want to see now at this point is a break of structure back to the upside. So notice leading up into the spring, notice how, the seller, right, the secondary test, really what this is just inducing retail traders. Notice how the ST was creating these equal lows, right? And retail traders love to buy these double bottoms, triple bottoms. Notice how it tapped this support 3 times. The support was not supporting here, fam. The support was not supporting, and it got ran through, basically putting in that spring that we're now seeing right now. So you can see that we were making, lower lows, lower highs, lower low, lower high, lower low, and we were now, anticipating a flip back to the upside. So liquidity got rated, put in the spring, and now we want to see that boom, break of structure. So we had a clean, people call it chach, right? Change of character. Some people call it market structure shift. Some people call it break of structures. It really does not matter. It's the same exact thing, right? But basically, right, that spring in terms of smart money concepts, really what that is just the FU candle, right? So you can basically, right, once we put in that new high, shifting structure back to the upside, your eyes should immediately go back to this whole last push down. And really, you can refine it to this last sell to buy candle, this last 5-minute FU candle right here. So then simply what you want to do is put your entry at the candle, that open of the candle, or 50% of that candle, and then stop loss underneath the low. And then you want to target the buy side liquidity. We have more buy side liquidity and Asian highs. And then we have the swing high right here. So you have 3 areas that you can target for these buys. And notice, market came right into that point of interest that we had, right? We put in the test. And again, the test, really what the test is just a mitigation of that FU candle. So the test after the spring, once you get a nice confirmation, break of structure, test is that mitigation of that FU candle. And then after that, we want to just ride this thing to our targets. TP1 and 2 smacked, and then TP3 ultimately about to get smacked right here. Boom. Beautiful. Beautiful, beautiful. So one thing I do want to actually point out, I'm going to pause it right there. One thing I do want to point out as well, guys, is once price does put in a new high, I don't know why this thing didn't pause, but whatever. But once price puts in a new high, right, we took out this swing high. Now we're now shifting back to the upside. And now like 1 minute, 2 minute, 3, 5, 15 minutes are all shifting to the upside. Once we had a nice expansion, price can't go up forever, right? Same way price can't just go down forever. It needs to make waves, right, or trace. So once the market starts to, it makes a new high, what you want to really anticipate is distribution schematics, right, above new highs, right? Same thing with accumulation. Once the market is oversold and we make a new low, you want to look for accumulation schematics to form under new lows. So right here, right, once we put in that new high, right, you should already be scaling out of your positions, taking profits, right? Notice how once we're making our way higher, price starts to, expansion starts to get smaller, right, and retracement starts to get deeper, right? Expansion starts to get smaller, retracement starts to get deeper, ultimately starting to break structure and make those change of characters. So we had that right there, change of character. And now what you want to identify is your distribution schematic. So right here we have our preliminary supply, our buyer's climax, our automatic rally. I'll make this a little bigger so you guys can see it better. Automatic rally, right? We have our secondary test. We have our signs of weakness. We have our upthrust. We have our UTAD, and then our test, and then preliminary supply, right? So even off of these examples, you could have been catching these shorts down to target these lows, right? Understand that we could even been targeting these lows. So that's why you always want to have exits, because your exits sometimes are more important than your entries, believe it or not. But yeah, we had these things we can target, points of interest, liquidity areas. And one thing I want to point out is you want to stay fluid in the market, right? You always want to stay fluid because yes, these sells did play off. You could have caught a pretty decent RR, like a 1 or 2, 1 or 3 on this opportunity. Price eventually came back and gave us another opportunity. But one thing I did want to point out was we had these eco lows that got ran through. Okay, these eco lows got ran through right here. And then the way that price reacted after that was now where you want to be fluid and flow with the market, right? We're starting to shift back to the upside on different on various different time frames now, right? So you can see that once this liquidity got rated, this last impulse down, right, this institutional movement, the FU movement was put in. Then after that, we created and put in a new high, right, creating that change of character. So we could have basically capitalized off this last push down, right, after this one candle FU, this 1 minute FU candle, entry right there, stop and loss underneath that low, and then you could have been riding these buys as well to this high, and then ultimately this high right here, for a solid 1 to 6 as well. And then once price guess what? We put in a new high. We started to do what? Distribute, right? After making a new high, we started to create a distribution schematic. Notice how impulses are starting to, get smaller and retracement starting to get bigger. Notice how, we're making, once we're oversold, we start to curve, right? And then we make that markup. And then what happens once we're oversold? We start to make that curve again, right? Notice how we're starting to make this curve. Once we had this distribution schematic form, you could have also capitalized, on sells in here and rode them to these lows and liquidity targets, right? And really, you could also, another thing that can help you filter out trades as well is measure out the range, right? Put your fib from the low to the high of the range, and then anything underneath the equilibrium, right, the 50% of that range, anything underneath there is considered discounted prices, right? You want to buy in discounted prices, right? You want to be selling in premium prices, right? Same way when you go shopping, you want to get those deals, right? You want to get those discounts. So same thing, when you're selling something, you want to sell it for as high as possible as you can. So once price did dip into our discounted area of the range, guess what? We started to get oversold once again, started making that curve, started creating the schematic, right? We put in the spring, we got the test, we mitigated the FU candle, and then this thing started to run up again. So boom, there you go, guys. That was all in literally one trading day. Coming out of Asian into London, you had really, really solid buys, like a 1 to 8, 1 to 10, depending on entry and targets, right? You had a sell opportunity around New York Open. You had another buy opportunity around like 10 a.m. Central Time, another sell opportunity, and another buy opportunity. So there's many, many opportunities. And, this is just a video I wanted to release to you guys, showing you guys how here at Money Heist we use smart money and Wyckoff concepts, liquidity concepts, to basically create our biases and trade setups for very precise, low risk, high reward setups. So if you guys enjoy this content, let me know, guys. Like this, save this video, share this with people that think can get value, and that's gonna just inspire us, motivate us to continue to create this content to help you guys and become profitable traders. So with that being said, guys, that's it for this video. We'll see you guys on the next one. Peace out.